Silver did not fall quietly. It did not drift. It did not correct. It snapped. Across China and the United States, leverage began to unwind at the same time. Futures collapsed, margins were hit, and positions were forced out in rapid succession. And yet, something strange happened. While paper silver was being sold aggressively, real metal was still being bid for. In some places, it was harder to get, not easier. Two markets showed two different prices for one metal. This was not a normal sell-off. It was not about sentiment. It was not about headlines. This was what stress looks like before it becomes obvious. And by the time everyone agrees on what happened, the damage is already done. Because this drawdown is not the story. What it reveals about leverage, liquidity, and global risk is the real warning. Welcome to the currency game. This channel speaks to those who have been watching markets for decades, who have seen cycles repeat themselves, and who understand that experience matters more than speed. If these conversations feel familiar, if they echo lessons learned the hard way, consider subscribing not for excitement, but for clarity, perspective, and discipline. And before continuing, viewers are invited to share in the comments the country they are watching from today. They began by observing the price, but they did not stop there. Silver fell sharply over a short period of time. The move was sudden, fast, and disorderly. Prices dropped in large steps, often without pause. To many, it looked like panic. To others, it appeared to be weakness. But neither description was accurate. This was not a story about fear. It was a story about structure. Silver futures were hit first. Highly leveraged positions were forced to unwind as margin requirements tightened and liquidity thinned. Traders who had borrowed to hold exposure were no longer given a choice. Positions were closed automatically. Selling accelerated not because confidence vanished, but because rules were enforced. This distinction matters. When markets fall, due to weak demand, prices usually decline gradually. Buyers step in and order remains. What happened here was different. Selling did not wait for buyers. It overwhelmed them. At the same time, physical silver told a different story. In key physical markets, especially in London, bids for real metal did not disappear. Dealers continued to quote prices for immediate delivery. In some cases, availability tightened. This created a rare divergence. Paper prices were falling while physical demand refused to collapse. This confused many observers. They asked a simple question. How can silver fall if people still want it? The answer was not belief, it was leverage. Leverage compresses time. When it is removed, events that should take weeks unfold in hours. Futures markets, designed for efficiency, become channels of forced liquidation. The headlines arrived late. Explanations were offered. Interest rates were mentioned. The dollar was blamed. Sentiment was discussed. None of these fully explained the speed or the pattern of the move. Because this was not a macro decision, it was a mechanical event. Across China and the United States, risk controls tightened almost at the same time. Exchanges raised margin requirements. Clearinghouses reduced tolerance. Capital became more expensive to deploy. The system responded exactly as it was designed to respond. Silver sits at a unique intersection. It is part industrial metal, part financial instrument, and part speculative vehicle. This makes it especially sensitive when liquidity tightens. As selling intensified, price discovery began to fragment. Different regions reflected different realities. Shanghai did not fully align with New York. London physical flows did not mirror futures behavior. Instead of one global price, the market showed several. Backwardation appeared briefly in parts of the market. This was not a signal of optimism. It was a signal of stress. It suggested that immediate delivery was valued differently than future promises. Institutions noticed this. Many retail observers did not. Gold also declined, but with restraint. It behaved like a senior asset. Silver behaved like a leveraged position being reset. This contrast mattered. The drawdown was not a judgment on silver's long-term value. It was a reset of risk. For business leaders and entrepreneurs, this matters beyond metals. Similar leverage structures exist across equities, credit, and currencies. When one area is forced to deleverage, pressure often spreads. Silver simply spoke first. And when a market speaks this clearly, it is rarely finished talking. They did not begin by asking who was right or wrong. They began by asking how the system itself behaves under pressure. Leverage is often misunderstood. Many assume it is simply borrowing more money to make more profit. In reality, leverage is a chain of promises. It connects traders to brokers, brokers to clearinghouses, and clearinghouses to the stability of the entire market. When conditions are calm, this chain feels invisible. When stress appears, every link is tested at once. Silver sits deep inside this chain. In futures markets, most silver exposure is not backed by physical metal. It is backed by margin. Margin is a small amount of capital posted to control a much larger position. This works efficiently when prices move slowly. It fails when prices move quickly. As silver prices began to fall, margin requirements changed. Exchanges are designed to protect the system, not individual traders. When volatility rises, they demand more collateral. This is not a judgment. It is automatic. The moment margin requirements increase, leverage contracts. Traders must either add capital or reduce positions. Many cannot add capital fast enough. Others are restricted by internal risk limits. As a result, positions are closed. Selling occurs not because traders want to sell, but because they must. This is where acceleration begins. Forced selling pushes prices lower. Lower prices trigger more margin calls. More margin calls create more selling. This loop feeds on itself. It does not need news. It does not need fear. It only needs mathematics. At the same time, liquidity thins. Market makers widen spreads. Bid sizes shrink. Depth disappears. Each sell order moves the price further than expected. This makes the next margin call arrive sooner than the last. This is how leverage unwinds quickly. China and the United States both play critical roles in this process. They are not separate systems. They are linked through capital flows, derivatives exposure, and risk management frameworks. When one tightens, the other feels it. In China, regulatory oversight of commodities trading has increased in recent years. Position limits, account monitoring, and volume controls are enforced aggressively during volatile periods. When abnormal trading behavior appears, restrictions follow. In the United States, the response comes through clearing and margin discipline. Clearinghouses adjust requirements. Brokers reduce exposure. Funds rebalance risk. These actions often occur within the same time window. The result is synchronized deleveraging. Silver reacts faster than many assets because it attracts speculative positioning. It is volatile enough to promise large gains, but liquid enough to allow scale. This combination draws leverage during rising markets and expels it violently during declines. Importantly, this process does not reflect long-term belief. Many of the same institutions forced to reduce exposure may still believe in silver's future role, but belief does not override risk controls. Structure always wins. As leverage exits the system, the market changes character. Price action becomes erratic. Correlations break. Assets that usually move together begin to separate. This confuses observers who rely on historical relationships. But this confusion is a signal. It tells experienced participants that the market is transitioning from a leveraged phase to a liquidity-driven phase. In such phases, price does not reflect value. It reflects balance sheet stress. Physical markets behave differently because they operate on delivery, not leverage. A buyer of physical silver must pay in full. There is no margin call. There is no forced liquidation. As a result, physical demand can remain steady even as futures prices fall. This divergence is not a contradiction. It is a feature of a fragmented system. As leverage unwinds, futures markets lead the move. Physical markets lag. Eventually, the two reconnect, but only after excess risk is removed. For businesses and investors, the lesson is not about silver alone. Leverage exists in many forms. It exists in inventory financing. It exists in currency hedging. It exists in growth strategies built on cheap capital. When leverage unwinds, time compresses. Decisions that could have been gradual become urgent. Optionality disappears. Those who understand the mechanism do not panic. They recognize the pattern. They know that forced selling creates distortions, not clarity. Silver's drawdown revealed how quickly conditions can change when leverage dominates positioning. It showed that stability is often borrowed, not owned. And once borrowed stability is withdrawn, the system reveals its true weight. In the next phase, attention shifts from mechanics to meaning, from how the system moves to what the fractures inside it are trying to say. They noticed it only after the damage was already visible, not because the information was hidden, but because most people were looking in only one place. Silver did not have a single price during the drawdown. It had several. On screens, futures prices were collapsing. Candles printed rapidly, each one extending lower than the last. To the casual observer, this looked like a clear verdict. Silver was weak. Risk was being rejected. The market had spoken. But elsewhere, a different conversation was taking place. In physical hubs, particularly in London, bids did not vanish. Dealers continued to quote for immediate delivery. In some cases, spreads widened, not because demand disappeared, but because inventory was harder to replace quickly. This is where the fracture appeared. Under normal conditions, global markets converge. Arbitrage connects regions. If prices diverge, capital moves to close the gap. This process creates the illusion of a single global price. During stress, that illusion breaks. Transportation delays, financing constraints, and risk limits prevent arbitrage from functioning smoothly. The cost of moving metal, capital, or exposure rises sharply. What was once profitable becomes dangerous. As a result, prices are allowed to diverge. This divergence is not noise, it is information. Shanghai reflected one reality. New York reflected another. London reflected a third. Each price was correct within its own system. None of them told the full story alone. Futures markets were dominated by leverage reduction. Physical markets were governed by availability and settlement certainty. These forces operate on different timelines. Backwardation briefly emerged in parts of the silver market. Many misunderstand this signal. It is often described as bullish or indicative of shortage. In reality, backwardation during stress usually signals urgency, not optimism. It suggests that immediate delivery is being valued more highly than future promises. This can happen when confidence in smooth settlement weakens, even temporarily. Institutions monitor this closely. They do not interpret backwardation as a trade. They interpret it as a condition. It tells them something about trust inside the system. It tells them whether counterparties prefer possession over paper. At the same time, correlations began to fail. Silver did not behave like gold. It did not behave like industrial metals. It did not behave like risk assets or safe havens. It behaved like a stressed instrument trapped between roles. This confused many participants. Retail observers often rely on historical relationships. When those relationships break, they assume something is wrong with the data. Professionals assume something is wrong with the system. Fragmentation is rarely visible during calm periods. It only appears when liquidity becomes selective. Capital does not disappear entirely. It chooses where to go and where not to go. In this case, capital chose certainty. Physical buyers paid for metal. Futures traders reduced exposure. Arbitrageurs stepped back. Market makers protected balance sheets. Each action made sense individually. Together, they created dislocation. This is how markets signal internal strain without making headlines. The danger lies in misinterpretation. Many assume that falling futures prices mean falling real-world demand. During leverage unwinds, this assumption fails. Futures reflect forced behavior. Physical markets reflect intention. Neither should be ignored. For decision makers, this matters beyond commodities. Similar fractures appear in currencies, credit spreads, and even equity indices during periods of stress. When derivatives detach from underlying flows, price becomes a poor guide to reality. Fragmentation is a warning sign. It suggests that the system is prioritizing survival over efficiency. It suggests that risk is being repriced unevenly. It suggests that confidence in seamless execution is being tested. Silver revealed this fracture clearly because it lives at the intersection of paper finance and physical utility. Few assets expose structural tension as directly. When one metal begins trading at multiple prices at the same time, it is not confused. It is reporting. And what it is reporting is not finished yet. Because fractures rarely remain isolated. They spread. They did not treat the silver drawdown as an ending. They treated it as an opening signal. Markets rarely break at their strongest point. They fracture where leverage is concentrated and liquidity is assumed. Silver happened to sit at that intersection. What followed was not a judgment on one metal, but a demonstration of how modern financial systems behave when stability is removed. The first implication is about timing. Leverage unwinds do not happen in isolation. They usually appear early in a stress cycle, before earnings fall, before defaults rise, before headlines change tone. By the time broader markets react, the adjustment is already underway. Silver moved early because it could. Its volatility allowed pressure to surface quickly. Its leverage made that pressure visible. Other assets may follow later, but they rarely announce themselves as clearly. The second implication concerns capital behavior. During leveraged phases, capital chases return. During deleveraging phases, capital chases liquidity. This shift changes everything. Assets that looked attractive on valuation lose attention. Assets that offer certainty gain preference. This is why gold held up better than silver. It is not because gold is stronger. It is because gold carries less embedded leverage. It demands less explanation when conditions deteriorate. Businesses face a similar reality. Companies that rely on cheap financing, rolling credit, or constant market access become vulnerable when leverage contracts. Even profitable operations can struggle if liquidity dries up at the wrong moment. This is not theoretical, it is mechanical. The third implication lies in volatility. Volatility does not appear randomly. It resurfaces when risk has been mispriced for too long. Extended calm creates complacency. Complacency invites leverage. Leverage amplifies shock. Silver's sudden movement reminded markets that volatility was never eliminated. It was deferred. Once volatility returns, strategies built on stability begin to fail. Hedging becomes more expensive. Forecasting becomes less reliable. Decision-making windows shrink. This environment rewards preparation, not prediction. The fourth implication involves correlation risk. During calm periods, assets move together in predictable ways. During stress, those relationships break. Silver decoupled from gold. Futures decoupled from physical markets. Regional prices diverged. The same phenomenon can occur across portfolios. Assets assumed to diversify risk may fail to do so when liquidity matters more than theory. This is why professional risk managers stress test correlations under pressure, not comfort. Silver exposed this risk cleanly. The fifth implication is psychological. Leverage creates confidence during expansion. It creates denial during contraction. Many participants initially refused to accept what was happening, and they searched for explanations that preserved existing beliefs. This delay is costly. Markets do not wait for consensus. They move when constraints tighten. Those who adapt early preserve options. Those who wait for clarity often receive it too late. For young entrepreneurs and business leaders, the lesson is subtle but critical. Growth built entirely on favorable conditions is fragile. Resilience requires margins of safety. It requires liquidity buffers. It requires understanding where dependence on external stability exists. Silver's drawdown was not a call to fear. It was a call to awareness. It reminded observers that financial systems are layered, that paper claims behave differently than physical assets, that leverage magnifies not only gains, but fragility. Most importantly, it demonstrated that stress often reveals truth faster than success does. This episode does not predict collapse. It does not guarantee recession. It does not offer certainty. What it offers is information. It shows how quickly conditions can change. It shows where pressure first appears. It shows which assumptions are most vulnerable. Those who pay attention do not panic. They adjust. They reduce dependence on borrowed stability. They review exposure to liquidity risk. They question assumptions formed during calm periods. Silver spoke clearly, not because it wanted attention, but because it was forced to respond. And when forced responses begin appearing across markets, they rarely stop with a single asset. They continue, quietly, systematically, until everyone is finally listening.